Today, what's happening to Canadian home prices? Hello again, it's Martin North from Digital Finance Analytics. Well, this post covering finance and property news with a distinctively Australian flavour. Well, Canada is an interesting analogue to Australia in so many ways, with its reliance on resources and massive exposure to property. Indeed, prices in some centres boomed through the recession, but now property values are falling and further drops are expected. So today we look at analysis from Canada thanks to RBC Economics. But before I start, a quick reminder that if you value the content we produce, please do like the post and consider subscribing to receive future updates. This really makes a difference to us getting our messages out, as views, likes and subscriptions drive the YouTube algo. And a word of thanks to those who support what we do. Now, RBC says that the Canadian Central Bank interest rate increases will ultimately tip the US and Canadian economies into moderate recessions next year. And they also expect interest rates will continue to rise in other countries. In the euro area, they expect a downturn to begin later this year, and growth is also softening in the UK. The drop in demand that accompanies these developments is expected to help lower inflation, but that doesn't mean central banks are done hiking rates yet, they said. While a mild recession is likely on the cards, forceful action from central banks now is meant to avert a much more damaging recession in which wages and price inflation spiral out of control. And looking at Canada in more detail, they say higher commodity prices and the recovery in Canada's travel and hospitality industry have supported near-term economic growth. This suggests a 4.5% annualized increase in GDP in the second quarter. And at 4.9%, the unemployment rate in July and June was at record lows, dating at least back to 1976. But shortages of labour are capping production growth, and high interest rates and inflation are cutting into household purchasing power. And excessive demand in labour markets is keeping unemployment very low for now, with job openings running more than 6% above pre-pandemic levels and pushing wages higher. But they continue to expect economic growth to slow substantially over the second half of 2020. And they say that the housing market in Canada has pulled back dramatically, with home resales down 27% between March and June. National benchmark home prices have started to decline, down 3% in April through to June, and more declines are expected as central banks continue to raise interest rates. The pandemic may not be over, but the pandemic-era housing market boom certainly is, they say. Since the Bank of Canada began hiking its policy rate in March, home resales have fallen 31% and benchmark prices around 6% nationwide, including monthly declines of 5.3% and 1.7% respectively in July. Most of Ontario and British Columbia have seen even greater drops, and the bottom is likely many months away still, as the central bank has more work to do. They expect a further 100 basis point rate increases to 3.5% by the autumn. With the balance of power having dramatically shifted in their favour, buyers, they say, will be in a position to continue extracting price concessions from sellers for some time to come. Formerly overheating markets in Ontario and parts of British Columbia, Lower Mainland, have been the epicentre of the downturn to date. Cambridge was down 17%, Kitchener-Waterloo down 16%, Brantford down 40%, London down 40%, and Guelph down 10%. They've all experienced the biggest declines in the composite MLS home price index since the February peak. In dollar terms, the loss in value is strikingly varying from $95,000 in Guelph to $166,000 in Cambridge. Prices have also been under heavy pressure in the Greater Toronto area, where the composite MLS HPI is down 7% or $89,000 in the past 5 months. And the Fraser Valley is leading the correction in British Columbia, with the composite benchmark pricing falling 5.6% or $65,000 since March, slightly more than twice the decline in the Vancouver area. In Quebec, gradually moderating activity is now taking the edge off prices, with the composite MLS HPI falling slightly in the past 2 months in both Montreal and Quebec City, suggesting peak prices are likely behind us. It's a similar story in parts of Alberta, Manitoba, and Nova Scotia, where the softening in prices began 2 or 3 months back. So they think that there is evidence now for a generalized downturn in Canada. Still, markets outside Ontario and British Columbia generally face a milder correction, they say, as buyers in relatively affordable markets are less sensitive to interest rate hikes, so they expect demand to be more resilient there. And the fact that home sales have so far remained above pre-pandemic levels in the prairie provinces and most of Atlantic Canada are a case in point. While likely to soften modestly, demand-supply conditions, they say, are well anchored in balanced territories in these regions. And the Bank of Canada's outsized 100 basis point rate hike delivered on July the 13th did throw ice-cold water on the market and disqualified some buyers from obtaining a mortgage and shrinking the size of a mortgage others can qualify for. Their expectation is for an additional 100 basis point rate hike increase over the next two rate announcements in September and October, and that will no doubt keep chilling things further. So they project home resales will fall 23% in Canada over this year and a further 15% next year, and they believe the market will adjust to higher interest rates by early 2023. Any recovery, they say, will likely take a few months to tighten demand-supply conditions, placing the bottom for prices around the Canadian springtime. That's overall for Canada. And they expect benchmark prices will be down around 12% from the recent peak nationwide. And on a provincial basis, they think Ontario and British Columbia could record peak-to-trough declines exceeding 14%, and Alberta and Saskatchewan at the other end of the scale with drops of less than 3%. And just adding to our story on Canada, Canadian year-over-year CPI growth saw its first moderation in over a year, falling to 7.6% in July from 8.1% in the prior month, according to data released overnight. The dip in the headline rate was entirely accounted for by lower gasoline prices, which dropped to around $1.85 a litre by the end of July, after breaking the $2 per litre mark in June. Other notable items that contributed to the downward inflation read in July included home buying related expenses, which have persistently trended lower since May, following Bank of Canada interest rate hikes, and higher mortgage interest costs were able to offset some, but not all, of that decline. And also in July, costs for food rose to 9.2%, and prices for hotels were up 47.7%, travel tours up 9.4%, and airfares up 57.7%. Also continue to surge above levels a year ago amid heated summer travel demand. Natural gas prices spiked as earlier market price increases worked their way into regulated price increases, particularly in Ontario. Near-term headline inflation readings should continue to track gasoline prices lower, they said. Indeed, pump prices fell by another 6% over just the first 2 weeks of August. Meanwhile, some cooling in the housing market, easing global supply chain constraints, and lower commodity prices will all work to ease price pressures for a wider array of products. So it's not unreasonable to expect the headline CPI rate, together with the breadth of inflation pressures, to be turning a corner. But they say the pace of inflation is still far above the Bank of Canada's comfort zone, and consumer demand will likely need to soften a lot more for CPI growth to fully and sustainably return to the central bank's 1 to 3% target range. So they think 62% of the consumer basket was still seeing inflation relative to pre-pandemic levels at an annual rate that's higher than 3%, the top end of the bank's target range in July. And so they look for the Bank of Canada to hike the overnight rate by 75 basis points in its next meeting in September, and to bring it up to 3.5% subsequently by the end of this year. So another story of home prices falling as rates are rising, and it does show the very strong relationship between credit availability and home prices. We're seeing this play out, of course, across New Zealand and Australia and the UK and elsewhere. So it's worth just keeping an eye on where rates go and what that means for house prices ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.